Profitable investment tips for young adults. What you need to know. Tired of living paycheck to paycheck? Want to build wealth and secure your future? You're in the right place. We're diving into the world of investing, specifically tailored for young adults like you. Let's unlock the secrets to financial freedom. Why should you, a young adult, even think about investing? Shouldn't you be focusing on enjoying life? The truth is, starting early is the single biggest advantage you can have in the investment game. Time is your greatest asset. The earlier you start, the more time your money has to grow. This isn't just about saving, it's about making your money work for you. The power of compounding is truly magical. It's earning returns on your initial investment, and then earning returns on those returns. Think of it as a snowball rolling down a hill, getting bigger and bigger. Before you jump into any investment, you need to understand your risk tolerance. How comfortable are you with the possibility of losing money? This will guide your investment decisions. Assessing your comfort level with risk is crucial. Are you okay with seeing your investments fluctuate wildly, or do you prefer a more stable, predictable path? Be honest with yourself. There are generally two main approaches: conservative and aggressive. Conservative investors prioritize safety, while aggressive investors are willing to take on more risk for potentially higher returns. Diversification is a fundamental principle of investing. It's about spreading your investments across different asset classes to reduce risk. Think of it as a safety net for your portfolio. "Don't put all your eggs in one basket" is a classic analogy. If one investment performs poorly, the others can help cushion the blow. This protects your overall portfolio. The benefits of diversifying your portfolio are numerous. It reduces volatility, increases your chances of long-term success, and allows you to participate in different market sectors. Stocks are a popular investment option, representing ownership in a company. When the company profits, your stock value can increase. This offers the potential for significant growth. Investing in individual companies can be exciting, but it also carries more risk. You need to research the company thoroughly and understand its business model. Mutual funds and ETFs, exchange-traded funds, offer a diversified way to invest in stocks. They pool money from multiple investors to buy a basket of stocks, reducing individual company risk. Diversification within stocks is also important. Consider investing in different sectors, industries, and geographic regions to further spread your risk. Bonds are generally considered a less risky investment than stocks. They represent a loan you make to a company or government, which they repay with interest. Bonds provide a steady income stream through regular interest payments. This can be a valuable source of income, especially during retirement. Bonds play an important role in a diversified portfolio. They can help to stabilize your portfolio during times of market volatility and provide a more predictable return. Real estate can be a lucrative investment, offering both rental income and potential appreciation in value. It's a tangible asset that you can see and touch. Investing in real estate requires significant capital and research. You need to understand the local market, property values, and potential rental income. Rental properties can provide a steady stream of passive income. However, they also require management and maintenance, which can be time-consuming. REITs, real estate investment trusts, offer a way to invest in real estate without directly owning property. They are companies that own and manage income-producing real estate. Cryptocurrencies are a relatively new and volatile asset class. They offer the potential for high returns, but also carry significant risks. Are cryptocurrencies the future of finance? Some believe they are, while others are more skeptical. The technology is still evolving, and the regulatory landscape is uncertain. Volatility is a key characteristic of cryptocurrencies. Prices can fluctuate dramatically in short periods, leading to both significant gains and losses. It's crucial to understand the risks involved before investing in cryptocurrencies. Only invest what you can afford to lose, as there is no guarantee of returns. Start small and be patient. You don't need to invest a lot of money to begin. Even small, consistent investments can add up over time. Investing is a marathon, not a sprint. Don't expect to get rich overnight. Focus on long-term growth and stick to your investment plan. The power of compounding over time is truly remarkable. The longer you invest, the more your money will grow. This is why starting early is so important. The value of a financial advisor cannot be overstated. They can provide personalized advice, help you create a financial plan, and guide you through the complexities of investing. A financial advisor can help you assess your risk tolerance, set financial goals, and choose appropriate investments. They can also provide ongoing support and guidance. Let's recap the key points. Start investing early, understand your risk tolerance, diversify your portfolio, and consider stocks, bonds, real estate, and cryptocurrencies. Remember to start small, be patient, and seek professional guidance if needed. Now it's your turn to take action. Like this video if you found it helpful, subscribe to our channel for more investment tips, and share it with your friends who are also interested in building wealth. Don't wait. Start investing in your future today.